According to the former governor of the Bank of Canada, David Dodge, the Bank of Canada could push interest rates back down to as low as 3% by the end of 2026, which would represent about a 1.75% decrease from where interest rates are right now. But the question is this a reality? What could actually happen that would make it not a reality? And why are they expecting that that is where interest rates will be? And a lot of that has to do with what's called the neutral rate, which I'll explain in a minute. But this also has many expecting that the Canadian real estate market will pick up once again, which for first-time homebuyers who are sitting on the fence waiting for interest rates to go down could mean that waiting for those rates to come down could cost them more for houses. And it's anybody's guess how this will all play out. But what I want to do is I want to show you the factors. I want to show you how much housing prices would potentially increase with that 1.75% decrease. And I want to talk about the neutral rate and give you all the details you need in order to understand how to get a mortgage and how to do it properly going into this next interest rate cycle. But before I get into it, my name is Nolan Matthias, and if you want the latest Canadian financial and real estate news, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video. And if you're looking down and you're saying, hey, I thought I subscribed to this channel, why am I not showing a subscribe? Well, that's because this is a new channel dedicated to Canadian real estate. The old channel now focuses primarily on global economic trends. So if you're subscribed to that one, go ahead, still watch those videos. But if you want specific Canadian real estate and finance news, this is the place for you. So hit that subscribe button. Oh, and one last thing, if you still want to get a copy of my book, Mortgage Secrets, right here, totally for free, all you have to do is pay the shipping and handling, go to mortgagesecrets.ca, and this will explain a lot of the concepts with respect to how you should choose your mortgage going forward, because if you have a mortgage that you're getting right now or one that's coming up for renewal in the next little while, choosing the right mortgage today is going to play a major role in whether or not you can get lower rates when interest rates do come down, and if they do come down, that full 1.75%. So we're going to go back to a bit of an old format here. We're going to jump into the news headlines. For those of you who've been following me for some time, you know that this is like the old school Nolan Matthias stuff that we do. And I'm going to go back to it because this is compelling content. It's interesting, and it shows you a pretty good view of what's happening in the economy. And I want to start first with this article about TD Economics and the fact that they are now suggesting that Canada's economy is set to turn a corner. And I'm going to zoom this in for you just a little bit and go through the highlights here before we get into the interest rate cuts. Because what's largely happening here is we've seen the Canadian economy be in a position where it hasn't performed as well as it should have the last year or so. Obviously, that's due to higher interest rates. And now TD is suggesting that we can start to expect that the economy is going to turn for the positive. So things are going to get better. And in this article, they suggest that the economy is soft, but not facing a cliff, which will allow the Bank of Canada to be cautious while determining how restrictive interest rates need to be. The report highlights that after no growth during much of 2023, the economy has performed better in the first quarter of this year and is set to turn a corner. Then they go on to highlight, and I just pull out the highlights of these articles, the really important stuff. First off, even though the Bank of Canada has started to cut interest rates, borrowing costs will remain much higher than pandemic lows. So what they're saying, and David Dodge agrees on this because he's suggesting that interest rates will go down to 3%, not down to zero, essentially, is that you shouldn't be expecting that interest rates will go back down to where they were during the pandemic. It's just simply not going to happen unless there's another major economic catastrophe. It's not to say that it won't happen, but it's highly unlikely if the economy operates in the way that it should. And as inflation continues to cool, TD Economics is predicting that the Bank of Canada will cut interest rates 2 more times this year, both in quarter point moves. Now, I wouldn't expect that one of those will be in July. They've already made this move, and as you've seen in a moment here, or as you'll see in a moment here, I should say, the Bank of Canada was hesitant on actually making the move in June. They chose to, but the fact that they were hesitant about doing it in June is kind of creates this scenario where it's highly unlikely that they're going to do it again in July. What they'll do is they'll wait and see what happens with the economic data based on the quarter point move, and then they will adjust from there. And you have to keep in mind as well that they're watching the difference between the Canadian and the US dollar and how these interest rate cuts are going to impact that difference. Obviously, they want to put a cap on how low the Canadian dollar will go, because obviously that has all sorts of economic issues that come up if the value of the Canadian dollar goes down. Now, let's get into the David Dodge article here and the fact that the former Bank of Canada governor is predicting rates around 3% by 2026. And there's some interesting stuff in here. So, first of all, is this quote: following the Bank of Canada's recent decision to cut interest rates, a former Bank of Canada governor predicts interest rates to settle around 3% over the coming years. This is exactly what he said. He knows his stuff. He's run the Bank of Canada. So, for him to say something like this, you know, you have to keep in mind that he is coming from a position of all else being equal. So, if everything happens the way it's happening right now and there's no major changes, this is where he's expecting interest rates to go down. Now, he said with respect to the recent move by the Bank of Canada that the move makes good sense and the timing of future cuts will depend on continued progress on inflation. So, the more data they get, the more they'll understand how the interest rate cuts are affecting the economy, and then they will make further adjustments based on that. Nevertheless, we think we'll be by 2026 pretty close to 2% inflation rate. And so we ought to be back to a Bank of Canada policy rate that is close to neutral. And the new neutral is higher than the old one. I'll show you a little bit about this in a minute. And so what we're arguing is that rates will come back down, but probably only to about 3% in 2026, which is, by the way, just a little bit below the high side of the estimation of what the neutral rate is. Again, I'll show you that in a second. Now, what's interesting, though, is that on Wednesday, Fiera Capital Corp Chief Executive Officer Jean-Guy Desjardins, I have no idea who this is. I have no idea who Fiera Capital Corp is. I'm not even sure why he made this article or was mentioned in this article. But he said the conditions are right for Canada's central bank to lower interest rates to approximately 3% by the end of this year. Now, I'm going to tell you right now that unless there's something crazy that happens in the economy, this isn't going to happen. But we already have some people in the finance world saying that we should be getting down to 3% a lot more quickly than the Bank of Canada is actually going to do it. Now, let's talk for a second about what the neutral rate is, because the neutral rate refers to the point at which a central bank's monetary policy is not restricting or stimulating the economy. And as they mentioned down here, this is kind of like the Goldilocks number. It's hard to get to, it's hard to stay there, but if you do it perfectly, the neutral rate is where you want to be. So you're having an economy that is at full employment, that's working the way it's supposed to, and inflation is low. And to take this a little bit further, the World Economic Forum has an article on this and just a really great definition here, which points out that this is a Goldilocks rate. It is an elusive rate, and it's the elusive rate at which an economy operates at full employment and capacity and a steady rate of inflation. It is the rate at which the economy is neither stimulated or slowed down. So right now, we are at an interest rate that most people will agree is tightening up the economy. The neutral rate is where there's no longer any tightening, but there's also no stimulus being added to the economy, encouraging inflation to rise. Now, all this being said, with respect to the neutral rate, I want to show you a couple of things. So the evolution range of Canada's neutral rate. This shows a graph going back to 2019. At the beginning of the pandemic, the neutral rate was between 2.25 and 3.25%. Now, during the pandemic, when there was all kinds of things that had to happen with respect to stimulating the economy, that neutral rate was deemed to be 1.75 to 2.75%. Obviously, during the pandemic, they wanted to stimulate the economy. That's why we saw interest rates so much lower than this and almost in the 0% range. Now, what's happened is as of 2022, that neutral rate range has increased to 2 to 3%. And the most recent assessment of the neutral rate is that it's somewhere between 2.25 and 3.25%. So what David Dodge is saying is that he expects by the end of 2026 for the Bank of Canada to get interest rates into that 2.25 to 3.25% range. And he believes it'll be around 3% is where the Bank of Canada will eventually land. Now, that being said, it's important to note what happened recently in the Bank of Canada's deliberations. And this is a cool new feature in the last year where they actually talk about what was deliberated in their meetings. And one thing to note here is that the Bank of Canada wasn't absolutely set on reducing interest rates in June. They chose to, and they do this by vote, and they do this by consensus, but there were some members that thought that they should wait until July, wait for some data to come back in. So the bank's 6-member governing council considered waiting for more consumer price data in order to gain further assurance that it was time to start loosening monetary policy. Ultimately, they decided to cut the policy rate to 4.75% at their June 5th meeting. Now, they also noted that 4 consecutive months of slowing underlying price pressure was sufficient progress to warrant the first cut. That's why they did it. They had 4 months worth of data. Some thought they needed 5, but they chose to do it at 4 months. But still, policymakers were concerned progress on inflation could stall as it did in the US, and it has stalled in the US. And they agreed that monetary policy easing would likely be gradual and depend on incoming data. Officials agreed to emphasize their communications that they would take further monetary policy decisions one meeting at a time. So they're going to do it based on the data, and they aren't going to make any quick movements based on what some guy at Vieira Capital suggests that they should do. It's all going to be data-based decision making from here. Now, there's some other interesting stuff that came out of their deliberations. The first is they discussed the risk around the future path for inflation and economic growth, including the large number of households renewing mortgages at higher rates next year, which could curb spending and economic activity more than expected. And this is where we get into that conversation about choosing a mortgage in the next few years. And I cannot emphasize enough that you don't want to get a mortgage at a B lender. What's a B lender? Well, B is for banks. And the reason why is because if you're choosing a 5-year fixed mortgage at a B lender, at a bank, it's going to have what's called an interest rate differential that includes a discount. And that could create a significantly higher payout penalty than what you would have at a non-bank lender. Now, banks will call the non-bank lenders B lenders, but actually they're A++ lenders because these are the types of lenders that only take the absolute best clients possible. The reason why is because they need to have more security in their client base. And they also have lower payout penalties, which could potentially give you the ability over the next 3 to 5 years to get a lower interest rate. Because if the payout penalty is low and you can save more than what the payout penalty is, well, the math equation works and you save money. So if you choose a mortgage and you choose a 5-year fixed right now, you should be choosing it from a broker. And yes, I am a broker, full disclosure, but these lenders have better mortgages with better payout penalties. They aren't backloaded like the bank's mortgages are. And the reason why they have those is because they have to. If they didn't have better mortgages, they wouldn't exist because they simply wouldn't be able to compete with the banks. So keep that in mind if you're getting a mortgage in the next 2 years before interest rates come down. You want to make sure you minimize your payout penalty risk so that you can, in fact, get a better rate if interest rates do come back down as much as David Dodge is predicting. Now, they're also suggesting that cuts to interest rates could lead to an overheated housing market. And that takes us into another article here where they're interviewing Royal LePage CEO, Phil Sofer, I believe is his name. Yes, it is. And he's talking about the aspects of interest rates and how that's affecting the market. And after the Canadian Real Estate Association released data on Monday showing that the country's home sales for 2023 were the lowest since 2008, the president and CEO of Royal LePage says the tide is about to turn. He pointed out that changing market sentiment indicators like showings, which he says are way up, and they are way up across the country. More people are looking for houses. We're also seeing bidding wars on a pretty regular basis right now. Soper says that the anticipation of further interest rate cuts will likely cause buyers to act early. And much like the stock market, when you're in a position like this, when there's a big change coming, where people anticipate something coming, there's going to be action in the market before it actually arrives. And that is exactly what we're seeing right now in our mortgage business. We are seeing people start to apply for mortgages, anticipating that interest rates are going to get lower. There's going to be deals to be had on houses, and they're going to win if they start getting into the market. Now, one thing to keep in mind here as an aside is the old 1%, 10% rule. So for every 1% decrease in interest rates, you can expect that housing prices are going to face a 10% increase in prices headwind. So in other words, if interest rates do come down by 10% or by 1.75% over the next year and a half, that is essentially a 17.5% potential increase in the housing market. Now, that doesn't mean that that is actually what's going to happen, but that is the change in qualification for people, the change in the amount that people can afford that they will be facing, and therefore there will be upward pressure on the market as interest rates come down, which is why it's actually a pretty good idea right now if you're going to get into the market to be buying now, taking a little bit higher interest rate, but one that's flexible where you can refinance into a lower interest rate in the next year or two so that you are actually able to buy at today's prices and then adjust your mortgage 2 or 3 years down the road when there's a lower interest rate available. It gives you a deal on the house and then allows you to take advantage of lower interest rates later. And this is the big thing. If you're a first-time home buyer and you don't want to get in the market, if you think homes are going to be cheaper in the next 6 months, or in a month, you're probably going to stay out of the market. But if you start to think that interest rates are going to go down, there are going to be first time home buyers that will try to find that sweet spot and buy as the interest rates drop. And his last note here is overall, Soper explained that Royal LePage believes home prices will move 5.5% higher nationally by the start of next year. And, you have to take a real estate company's predictions with a grain of salt. They'll always be a little bit more positive than what general economists will say. But for the most part, Royal LePage has a pretty good track record of being pretty accurate on their predictions. So if you're looking at getting into the market, it is definitely a time where you need to be thinking about, what do I do from an interest rate strategy? What do I do from a mortgage strategy? It shouldn't be, I'm just going to go buy a home and get a mortgage and hope for the best. Think about the next 2 to 3 years, think about the mortgage that you're getting, and think about how to set it up so that if interest rates do come down that full 1.75%, you're in a position to take advantage of that. And I cannot emphasize enough that the banks have set up their mortgages so that you cannot take advantage of that. So look towards lenders like First National, MCAP, and if you need a great broker to help you with this, I mean, you need a good broker for sure, but if you need a great broker, my team at Mortgage 360 can help. Just go to the link in the description below. And by the way, if you purchase the book, you purchase the free shipping on the book. You also get a special deal on mortgages through Mortgage 360, but you have to have the book to know what that is. Oh, and if you want to see more information on what's going on with respect to interest rates, make sure you check out this video right here. It outlines the best interest rates for normal mortgages, discount mortgages, variable fixed, and takes you through the whole gamut of what you can expect when you're getting a mortgage right now.